In today's video, I'll teach you about 9 different types of investments. I'll rank these from least to most risky. I'll let you know the pros and cons of each of these investments. And then if you stick around to the end of the video, I'll let you know which investments you should be in based on your age and risk tolerance. So first we need to answer the question, what exactly is an investment? An investment is when you put your money into an asset so you can receive more money later. An asset is anything that has monetary value. So anytime you invest, you're acquiring assets. There's 2 main ways assets can bring you more money, which is through appreciation or generating income. When an investment generates income, it pays you to have ownership of it. For example, if I own a house and rent it out for $1,000 a month, then I'm getting $1,000 a month in extra income. And the value of the house also increases over time, which is appreciation. If I bought the house for $100,000 and now it's worth $150,000, then I have $50,000 in appreciated value, which is why real estate is a great investment because it gives you the best of both worlds. It appreciates and also generates income. So next we need to answer the question, what makes an investment more or less risky? So the more risky an investment is, the more likelihood it'll lose money or decrease in value and not give you the return that you want. The less risky an investment is, the more likelihood that it'll give you the return that you expected, and there's a low or no chance of you losing any money. However, there is an upside to investing in more risky assets. The more risky an asset is, the higher chance of return there is. For example, Tesla is a risky stock. You may lose 50%, but you may also gain 300%. However, if you buy a CD, your money is insured, but you're only guaranteed a 4% return with no chance of earning any more. So you need to ask yourself, am I willing to risk losing a portion of this money that I put into the investment to receive more later? Or do I want a no or low risk of losing any money? So risk in investments are mainly based off of 2 types of risk, which is market risk and liquidity risk. Market risk is when prices in any particular market increases or decreases based on supply and demand. The more people investing into an asset, the higher prices will go. And if more people are selling, then prices will drop. And liquidity risk is how fast an asset can be sold for cash. For example, stocks are highly liquid because you can place a sell order and get rid of them within a few seconds, while real estate is not because it could take months or years to sell that property. So now that we know what an asset is, how it can bring you more money, and what defines a risky asset, I'll explain the different types of investments. I'll let you know the pros and cons of each of these investments, and then I'll rank them from least to most risky. The first and least risky investments are cash equivalent accounts. These include CDs, high yield savings, and government issued bonds. CDs are issued by banks, and it's where you put your money into an account for a certain period of time for a set amount of interest. These terms can be any range, such as 3 months, 6 months, a year, or even 5 years. And usually, longer term pays the highest interest because it acts as an incentive to keep your money with the bank for longer. The pros of a CD is that you know exactly what you're getting into when you sign up for it. And usually, if you need to close out your CD before it matures, you still get your full principal amount back. And also, it's FDIC insured. The cons are that interest rates are typically really low. It's usually around 1 to 4%. If interest rates increase and you're in a longer term CD, you won't be able to take advantage of the increased interest rate. For example, if you invested last July into a 2-year CD, you would have gotten 2%. Now, if you did a 2-year CD, you'd get 4%. However, you would still have another year until maturity, so you would be stuck with a 2% CD while everyone else is making double that. High-yield savings accounts are where banks will offer an adjustable rate on your funds that's higher than a normal savings account. This rate is based on how the economy is doing and what the federal funds rate is. When the economy is doing well, then the government increases rates. And when the economy weakens, the government decreases rates. I also made a video on why the government increases or decreases rates, so if you want to learn more about it, I'll leave a link in the description below. But the pro to a high-yield savings account is it's very liquid, meaning your money is not locked up and you can get to it at any time. Also, there's no risk of losing any money, and typically it's FDIC insured. The cons are that interest rates fluctuate, so you are not guaranteed a certain return. Just because you're making 4% this year, next year you may only be making 1%. Also, there's usually higher minimums to get access to these accounts. For some banks, the minimum may only be $1,000, but for other banks it may be $100,000. I view high yield savings accounts as a placeholder account, which means that it's an account that you put it in until you figure out what you actually want to invest it in. Government issued bonds are issued by the government and sold to investors to support government spending. One of the most common forms of this is called treasury bills. Treasury bills are issued at a discount and then mature at face value. And most of them are issued for 1 year at a face value of around $1,000. So the difference between the purchase price and the face value is your accrued interest. For example, if you buy a treasury bill at a discount at $950 and it matures in a year at the face value of $1,000, then your interest rate is 5.26%. The pros of this type of investment is that they're backed by the government, which means that they're risk-free, so there's no chance of you losing any money. They're also easily tradable on the secondary market, which means you can easily get rid of it if you need to. Also, there's a low barrier to entry. You can buy a T-bill with as little as $100. The cons are they typically provide low returns depending on market conditions, which is usually less than inflation. They also don't provide any income leading up to maturity, so you'll have to sell or wait until maturity to get any of your money back. And they're subject to interest rate risk. For example, if I buy a treasury bill at 3% and rates jump up to 5% and I need to sell it on the secondary market, then I'll have to sell it at a discount or less than 3% because my treasury bill is less attractive to the market since rates are now higher. The second group of investments that I consider medium risk are index mutual funds, large cap stocks, and real estate. Mutual funds give investors the opportunity to pool their money together with other investors to buy a group of assets to achieve a common objective. For example, if I believe the US economy is going into a recession and will decline over the next few years, then I'll invest into an international fund, which invests in companies from other countries to avoid the expected decline of the US economy. And most mutual funds are actively managed, which means fund managers use their research and technical analysis to time trades and try to outbeat the market. However, index mutual funds is where investors put their money into a fund that mimics the market. The stocks in this fund are preset, so it's not actively managed by a fund manager, which reduces risk and fees. The most common fund of this type is called the S&P 500 Index Fund. This tracks the top 500 largest US stocks. Therefore, if the economy is doing good, it'll provide capital appreciation and dividends, because companies are growing and profiting. If the economy is doing bad, then it'll decline in value because companies are laying off people and really just trying to survive. The pros to the S&P 500 is that it's lower risk than individual stocks because it provides diversification. If one company is doing bad, it still has 499 others holding it up. Also, over the last 100 years, for every 10-year period, this index has averaged around 10% annually. So if you're holding it for a longer term, then your annual returns should average out to this rate, which beats any of the low or no risk accounts that we talked about earlier. The cons are that you cannot beat the market that the funds mimic, so you're constrained by how the stocks in this fund are doing. There's not a fund manager that can change the objective or invest in something different. They have to invest in the exact stocks that are in the S&P 500. Another con is that in some years the economy drops 30%, such as the 2008 recession or the COVID crash in 2020. You have to be willing to stay in for the long run to average out those down markets, so you'll have a lower risk of losing money. Large cap stocks are well-established companies that dominate the industry that they're in, and they're very stable and mature. To be labeled as large cap, you have to be valued at more than $10 billion. These are companies like Apple, Walmart, and Amazon. They typically hold themselves together in times of recession or negative events. For example, during the COVID market drop of 2020, the average company declined by over 30%. But by the end of 2020, Amazon had increased in value by 76%. This was due to more people being locked in their homes, and they can only shop online, which increased revenues and sales on their website. Also, Apple is almost like a monopoly now. People that have iPhones are gonna stick with iPhones and upgrade their phones whether or not the economy is doing good or bad, because they're used to the features and software of the iPhone, so it's hard to switch to something cheaper or even just different. The pros of large cap stocks are that they have lower volatility and typically provide a steady steady stream of income through dividends. Volatility is how likely a stock will suddenly go up or suddenly go down, and it's hard to predict. Dividends are where companies will give some of their profits to stockholders as income, instead of reinvesting or keeping the money themselves. For example, if a company is worth $100 a share and decides to give out a 5% dividend, then you'll get $5 per year. The cons to large cap stocks are, since they're not affected as much by market fluctuations, they don't have as much capital appreciation, which means they don't earn as much as mid cap or small cap stocks. The main reason for this is because their market cap is so high, which means billions of dollars would have to be traded to affect price, while smaller cap stocks can be affected by smaller amounts of money. Also, since the demand for these stocks are higher, it means prices are typically higher as well. To buy one share of Amazon stock, you would have to pay $140. To buy one share of a small or mid cap stock, it's typically less than $30. Real estate is any land or the buildings that are on it, such as residential houses or apartments, office spaces, commercial buildings, such as skyscrapers or restaurants, and sometimes even raw land that's being developed into campsites or lots to sell. The most common type of real estate is residential houses like the one that you live in. Real estate is one of the most sought after investments because it provides capital appreciation and it generates income, as we talked about earlier. The median home price in the year 2000 was $120,000, while today the median home price in the US is $440,000. However, the average rate of appreciation over the last 10 years has been about 7% every year. The reason for this is due to inflation and supply and demand of land and homes. The earth is not producing any more land while populations keep increasing, so demand increases while supply decreases. So homes and land naturally tend to go up in price. A pro to investing in real estate is that it typically provides 1% of the house value in rent each month. So if you have a house worth $300,000, then you can make $3,000 per month in rental income, or $36,000 per year. If you save that $36,000 in rent and also your capital appreciation of $21,000, then your net worth is actually increasing 19% per year, which is a return that is hard to get anywhere else. Some cons to real estate is that it's very illiquid, meaning it can take a long time to get your money out of the house, which could be years or months. Also, you could get bad tenants that don't pay rent and trash the house that would put you out negative income per month and also decrease the property value. But overall, I believe real estate is one of the best ways to build long-term wealth. There is a reason that 90% of the millionaires in the US are millionaires through real estate. The third group of investments that I consider high risk are cryptocurrencies, options, and small cap stocks. Cryptocurrency is digital money that doesn't require a bank or institution to verify transactions. Instead, it uses what's called a blockchain, which is an unchangeable ledger that tracks and records assets and trades. Just as stocks, many people use technical analysis to make trades and profit off of the price change of crypto. Technical analysis is when traders use charts to identify price changes and patterns. They believe past trading activity and prices will indicate future price movements, and they use this to their advantage. The most common type of cryptocurrency is Bitcoin, which has a market cap of around $570 billion. This means if it was a stock, it would be one of the largest top 10 companies in the US. This shows you just how much people buy and invest into Bitcoin. Some pros to this is that there's a maximum number of Bitcoins that can ever be produced, which is 21 million. Unlike the dollar, which just can be printed whenever the government needs it. When there's more dollar bills circulating in the money supply, the value of each of those dollars will decrease. However, since there's a cap on how many Bitcoins can be produced, this acts as a hedge against inflation. Also, the crypto market is always open, unlike the US stock market, which is only open 9:30 to 4 p.m. This makes it easier for traders to invest in cryptocurrencies that work a common 9-to-5 job. And the average return for Bitcoin over the last 10 years has been around 77% per year. However, Bitcoin has also dropped 16% in one day. So there's a risk versus reward trade-off. Some cons to this is that crypto has no refund or cancellation policy. So if you accidentally make a wrong trade, you may be stuck in it and lose money. Also, since it's not regulated, your funds could get stolen and there's no way to get it back. Options are financial contracts that give the buyer the right to buy or sell an underlying asset within a certain price and time period. There's two main different types of options, which are called calls and puts. A call is where you purchase a contract that gives you the right to buy a stock at a set price within a certain time frame. A put is the opposite, where you have the right to sell at a set price within a certain time frame. One option contract typically represents 100 shares or units. So if you buy 3 put options for Apple stock, then you have the right to sell 300 shares of Apple. This reduces cost and limits downside exposure, because the most you can lose is the premium that you paid for the contract, but you have access to the upside gain of owning 300 shares. If you were to buy 300 shares of Apple stock today, it would cost you around $55,000. But if you bought 3 option contracts, it would only cost you around $1,000. With these options, there's what's called an expiration date and a strike price. If Apple is selling at $182 per share, and I think prices are going to increase over the next 3 months, I could buy a call option with a strike price of $182 with an expiration date 3 months in the future. If the price increases by $5 to $187 within those 3 months, then I'll make $500. However, if the price drops, then I don't need to exercise my option to buy, and I've only lost the premium that I've paid for the contract. The pros to options trading is that you can easily earn 100 to 300% in a short period of time, and it gives you the ability to take advantage of the higher returns with the lower capital investment. The cons are that you're risking 100% of the principal that you're paying for this contract. Also, it's a lot more hands-on and complicated, so it takes more research and understanding of markets and stock prices to be successful. Small cap stocks are up and coming newer companies that are growing and are smaller in size. They typically have a market valuation of around $250 million to $2 billion. These include the viral companies that everyone's talking about, but also some companies that are going into bankruptcy and are about to be acquired by other companies. So there's a high risk for these stocks. A lot of times it's the new tech companies that have just developed a new software for cars, or a pharmaceutical company that's going to cure cancer. As you can imagine, manufacturers of cars may never use that software, or that cure for cancer may never come. This would result in the prices of those stocks to decrease tremendously. However, on the flip side, that new software may be the staple for all cars in the future, or a pharmaceutical company may finally develop the cure for cancer, which would result in unimaginable returns. Some pros to small cap stocks is that they have years to grow and can appreciate fast, while large cap stocks may appreciate very slowly because they're already mature and have gone through their growth phase. Also, institutional investors, which are funds that have billions of dollars, are less likely to invest in these stocks, so the average investor can have a bigger impact on price action. The cons are that liquidity is lower compared to large cap stocks, because less people may be buying that specific stock, so you may have to sell at a discount just to get out of it. Also, there's a lot less transparency with these companies because they're not as well known, which means there's less fundamental data to make your investment decisions on. A lot of times with these stocks, it feels like you're playing darts and you're trying to hit the bullseye, but most of the time you don't. So we've gone over risk levels and the pros and cons to these different types of investments. We know that CDs, high yield savings accounts, and government issued bonds are low risk. Index mutual funds, large cap stocks, and real estate are medium risk. And cryptocurrency, options, and small cap stocks are high risk. So finally, which one of these investments should you be in based on your age and risk tolerance? In general, the younger you are, the more risk that you can tolerate. The reason for this is that you have time to ride out the waves of the down markets, and also you have time to recover any funds that you've lost. For example, if I'm 20 years old and have 40 years until retirement, I can afford to lose or be in a down market because I don't have to sell or take out funds for a while, and I have time to accumulate more funds. However, if someone is 60 years old and plans on retiring next year, they're going to need to sell some assets so they can take a distribution for their living expenses. And this will require them to sell at a loss in a down market, and they don't have time to build their funds back up. So I like to follow a system called the Rule of 120. The Rule of 120 is where you take 120 minus your age And that's what percentage of stock you should have in your retirement portfolio. This means if you're 25 years old, then you should be investing 95% into stock for the long term. I always recommend the S&P 500 index that we talked about earlier because on average, for every 10-year period, you'll gain around 10%, and I'm okay with that. Also, real estate is a great play for a longer term asset at pretty much any age, and even into retirement, because it will give you extra income and it always builds capital appreciation, which in return builds net worth. It's just a little more hands-on. However, outside of retirement and long-term assets, CDs and high-yield savings accounts are a good short-term investment for any age. If you plan on buying a house in a year and you have your down payment sitting there in an account not earning anything, you might as well put it into a short-term CD or high-yield savings so you can make a few extra dollars. So to figure out which investment you should be in, you need to ask yourself, what is my time horizon, which is how long do I have to invest? Am I willing to lose any of the money that I put in? How hands-on do I want to be? And that will answer your question on which investment you should be in. The last thing that I want to leave you guys with is to start investing today. There's this saying called compound interest, which is where you make interest on top of your interest, and it results in exponential growth over time. So the longer you have to invest and keep your funds in an account, the more those funds will compound. There's a study that shows if you invest from age 20 to 30 and then quit investing and just leave it there until you're 65, then you'll have more money than if you invested from age 30 to 65. So investing for 10 years at an earlier age is actually better than investing for 35 years at a later age. So start investing today so you can achieve your financial goals and live a life of financial freedom. Again, thank you guys for watching. If you enjoyed the video, hit that like and subscribe button below, and don't forget to comment so I can answer yours in the next video.